So next we have Hogewoning. I hope I said that correct.
Very good, very good.
Tried. Talking about one of the models that you guys have built and some of the findings from that. So.
The concept of durability risk in that sense.
Yeah, super. So hand it over to you.
Clicker or anything for the presentation?
Yes, you just have to tap the thing.
Okay, sure.
Yes.
Perfect.
Yep.
Very good. Okay, so my name is Hogewoning. Concerning the time, I'll keep it short and sweet. I'm an advisor here at Ernst & Young at the Financial Services Risk Department from the Quantitative Advisory Services. So we are specialized in all the risk models at the big banks and insurance companies. And my background, however, is in civil engineering, specialized in water management. So perfect place here. And what my interest is also what I looked at during my thesis was combining a great source of data we have from a climate perspective and from, for instance, the KNMI, and trying to combine that with financial findings and the financial industry. One of the cases I used during my thesis was look at specific weather patterns and crop yields, and then connect that again to market price fluctuations. And that's sort of a way that you bring it together. So durability risk. What we do there is, when we're talking about duurzaamheid in Dutch, it's only one word. But when you translate it back to English, it's two words actually. It's sustainability and durability. And when we look at sustainability, it's much more a question of what is the impact of my investment on the climate. While when we look at durability risk, it's much more what is the impact of the climate back on my investment, and how do you put a number to that? And that's the question we're answering here. So when we look at climate risk and when we look at the financial industry, we see that there is a number of signals that the awareness is growing. And we see that in a number of aspects. So we see it in a financial aspect, we see it in a public awareness, and we see it in a regulatory push. We see that the extremes in the weather are increasing, and that's exactly where the source of a lot of the damages, the financial impact is. And here at EY we believe very much from a sort of bottom-up perspective in understanding what we're looking at in that sense before we say something about modeling it or putting a number to it. Financial impact. This is a figure from the München RE, and this shows the trend in the contribution of hydrological events to complete damages in the European Union. And what we see throughout the years is a sort of steady increase of that contribution with large impacts. It's by the way on a world scale, but large impacts such as I think Katrina is one of these, the floodings in Bangkok is one of them. And we can see that these large damages, the increasing, are providing a sort of constant increase in the impact on the financial industry. When we look at public awareness, this is from the World Economic Forum, from their 2019 report. And we see that the top 10 of the biggest risks defined by the experts in the field has actually been dominated by climate risks. So we see the extreme weather events, we see failure of climate change mitigation and adaptation. And if we look at how serious this problem is, that's weapons of mass destruction. So that's a pretty big one. The probability is a bit lower, but it's on the same par of the impact. And that's just to give an idea how serious the financial industry is actually looking and how the public awareness is changing in how important this subject actually is. When we look at the regulatory push, very interesting signs as well. From the PRA, they have already decided that climate has to be a part of your stress testing for the foreseeable future. And we see also in EIOPA framework, but also in European guidelines, and this is I think from the EIOPA framework, already stating that the critical value chain, locations in the critical value chain have to be defined, but also disclosures of the financial impact due to extreme weather events. So this is what we see in from a financial perspective, we see it from a public awareness, and we see it from a regulatory push. And then the big question also, of course, becomes very much what are we looking at? So just a very quick show of hands. Who thinks that climate change is a big problem? Well, there you go. Who thinks that climate change is a big problem for the financial industry? Okay, perfect. Who here can explain me how climate change works? Well, there you go. So, the climate change is much more than just it's heating up, and on days of today, it's maybe not the best day to say it, but climate change is a story of the energy in the atmosphere. It's a story about water, and it's a story about how the pressures and how the system actually that drives the weather on our planet works and how it reacts to an increase in energy. And bottom line is, the more energy we have in the system, the more extremes become very prevalent. That is in a very short story what it means. And it is exactly in these extremes that we find the biggest damages to the financial industry. Because what we see is a pattern of a change in probabilities. So the change in probabilities, this is for the temperatures at this point, is that when we have a normal climate, we could see a normal distribution, for instance, in the temperatures happening, and then the extremes are somewhere around here. But what we see throughout the last couple of years, and already in a couple of data sets, is the changing of these distributions. So what we see is the distribution moving to a side. So in this sense, it's moving to the right, so it's becoming warmer. And the distribution is becoming flatter, meaning that extremes become more prevalent. So what does that mean? Well, exactly what we have already seen in this very month. Today we're breaking heat records in the same place. At the beginning of the month, we had the coldest night in July forever in the Dutch history. Temperature difference of about 42 degrees in 1 month. So that's exactly what this is saying to us. The extremes are becoming more prevalent. But the next part of the puzzle becomes, what do these extremes actually mean? Can we put a price tag to it? So when we look at data from reinsurance companies, that's what we're doing at the moment. We're combining the amount of, we're combining extreme events. For instance, these are cloudbursts, wolkbreuken in Dutch. And we're combining, and we're putting a number to it. And so what you see is that if you have a damage event, a rainfall event of about 40 millimeters per hour, you already are talking about 8 million of damages on average. And if it's 50 millimeters an hour, we're already talking about 25 million and up. Copenhagen had a big cloudburst of 150 millimeters. That was 1 billion euros in damages, just caused by extreme weather events. And we see them increasing throughout the years. Purely data-driven, so even if you have a discussion about climate change, if it's real or not, this is what the data is telling us. It's a bit closer to home already that also happens. This is a data experiment we did from data from the KNMI, and this already shows us that the shift already happening quite close to home. This is a combination of rainfall close to Schiphol. And the blue line is what it used to be in about 100 years ago, and the purple line is what it is now. And this is exactly what we're doing here, is how do you calculate the risk? The probability and the increase in probability of something happening combined with the cost of something happening. And that is exactly your risk calculation you want. And then towards the future, extrapolation using climate scenarios from the IPCC and the KNMI to bring it forward into what does it look like in 30 years or even 40 years. So from a perspective from EY, how are we looking at this? What is the way forward? Because it's all very nice doom and gloom in that sense, but what it is all about is that it's a risk, but it's also very much an opportunity, and it provides, in that sense, tooling and also understanding on how we can actually manage this as a bank or as an insurance company or as an investor. In our opinion, it all starts, and it's also confirmed by the CICERO institution for Kliminvest, it all starts with insights. What kind of weather events are going to happen in the Netherlands? What are the damage mechanisms that happen there? How do you go from a physical effect to something financial? You bring it together with portfolio information from a client. So how is my portfolio concentrated? Why is it concentrated there? We combine that with actions. So to bring that together with how do you incorporate it into your framework? And then we go into progress, which is actually How do you go further? How do you bring it to an integration to your models? And how do you bring it forward into a sort of proactive role you can give to the financial industry? So it would look something like this. This is a very interesting case for instance, pole rot, or foundation degradation is, I think, the right word in English. Droughts cause subsidence in houses. About 1 million houses subsided last year, which is an average damage post of about 50K per house. So it's a 50 billion euro possible damage. And what we can see now is that this is the present, mapping about how much rain we're missing at this point, and then we bring it forward to 2050. Just very clean. All the difficult parts are on the back of this, all the models. That's where we're working together with the University of Delft and also with Climate Adaptation Services. And you bring it forward using cases where you can define why the damages are there. And if you zoom in a bit further, you have the city of Amsterdam. You can actually combine it and define where are the hotspots in my portfolio. Why are they there? How do the damage mechanisms work? And it is also, we're not developing weather models here in-house at EY. What we're doing is we're helping, we're combining partnerships. So with universities, we're working together with the insurance companies. We're using our knowledge of the models and also the financial industry to bring it together in that format. Using the strength of all the different parties and bringing it together to provide a product that gives insight and also presents an opportunity to get into actions. I'll keep it very short. The last bit a bit shorter. This is how we see it towards the future. So we have all the different data sources we use. We bring it forward to a current situation, and we bring it forward with what was already talked about, the laws and regulations, but also future predictions using IPCC and KNMI models to bring it forward into how does it look in 30 years. And we have a number of products where we're, parts we're working on, which we defined to help people understand the problem and how we go forward. And that's it. Thank you very much for your attention.